They tell me that they listening, so why you think I talk a lot? I'm making money on the markets, trading on phenomena. I beat the market every year, come meet me in the octagon.
Let's go, baby. We got the screens mobile, but today's crazy. It's actually chill. We just got done with the stream, but I want to go over this rate hike, what it means for the market. If you guys are new, today I'm going to be posting a lot of videos, so if you're new, it's going to be weird if I'm posting 4 or 5 videos, but for those of you who aren't, there's a lot we need to talk about. I want to talk about explaining this Fed rate hike for tomorrow, why it's so important. We've brought it up, and even as the days have come on and seeing the market lately, it seems like this is going to be the big focus. The other thing I was concerned about for this week that I said, if you could watch my video, I said this week's going to be crazy. Been documenting a lot of this stuff. Go take a look at it, but hopefully now the government shutdown is going to be relieved. They're going to take care of that. It seems like Trump is backing off, so that might not be an issue. But now is this question of the Fed rate hikes. And I said it in my video yesterday, and somebody even gave me shit for it. They were saying, well, because I called it a black swan. And I said maybe a gray swan would have been appropriate, but the fact that they said, well, it's expected that the Fed is going to raise. It was 75% odds. And they said, how is that a black swan? You said, weird. I want to talk about that because the situation going on with rates right now is interesting, and what that 70% or 75% at the time rate hike odds meant. I want to go over that because those odds have changed in the last 12 hours. And this meeting is very, very important, and it's going to give us opportunity to look at the other fundamental stuff in the market like bonds, fixed income, and all of that. So yeah, let's get into it. This tomorrow is going to be interesting. You know, the market, very, very volatile. Here's the SPY, then the SPX. But you see, we were just at, literally as I was starting the video, we were at the bottom, has this epic bounce. We have about, what, an hour and 45 minutes left. So a decent amount of time here, but we haven't been trailing with anything. You know, oil's been dropping, and that was one of those big factors I talked about in the past. And it was kind of following it today. And that kind of looks like the market, but not as much. Another thing I'm going to talk about, and I've told you guys to watch for, is the correlation between the S&P 500 and the Japanese yen. And that kind of looks more like our market here today, but that relates to the Fed rates, hiking rates and stuff. That's why I'm so excited, because this gives us an opportunity to look at this stuff. Now, also, if you watch the video I made yesterday, the important part about what happens here in the next coming days, in the next week, is that after a down Friday, down Monday indicator, it's where we go in the next few days. So if we don't continue to set new lows, if the Fed doesn't cause this or whatever it may be, more China growth, trade talks, and that was another thing I'm going to make a video on. Xi Jinping had a conference yesterday, and it wasn't really too good what he said. But essentially now, if the market doesn't come up, go hit new lows in the next few days, you could see it bottom, and we might see it come up, finish out Christmas, hopefully with some sort of bounce, or even maybe the first week. But I think after that, we might test another low. I'm going to keep you guys posted with that. I've already talked about it a lot. But now, what I have right here is the Fed rate monitor tool. So what they do is they use the 30-day Fed funds future prices that signals the market's expectation. So pretty much how the Fed fund rates are trading and how traders are trading the future prices on these is giving the probability. So somebody said there's a 75% probability. Yes, but it's not like the Fed gives out a probability. So that's the two issues. It's one, the market has a price that they're pricing in. Markets can be wrong, and that's how it works with, you know, that's where these quote unquote upsets come in. There's that, but now there's the next level of the well, I was blanking on that, but you know, essentially it's the fact that they're pricing it at these levels. You know, it's pretty much, it's going to change, and these are the futures, so it's not indicative. Okay, the next thing I was going to say is the dot plot. That is the next thing we're looking for. So after they determine whether or not they're going to raise or not, the next important is the dot plot, where they expect, where the people on the board of the Fed are expecting for rates to be. That's the only real probability prediction we have. So if that changes, that is what investors are worried about. Now, here's the issue though. The probability right now based on the futures is 72 to 27. So 27% by staying at 2.0 to 2.5, that means they stay. And 2.2 to 2.5 means they raise. But look here, it says previous day's probability on the raise, it was 68%. That was yesterday's what it closed at. In the previous week, it was at 75. Now it's at 72, and it briefly hit, it was at 69 earlier today. So pretty much what you're seeing, the probability is going up that they don't raise and that it's not. So it may seem like, okay, 75% though, how is that a black swan? Because here's the issue. Any number above 70, the Fed likes. If it's above 70, the Fed is more likely going to do it because that means it's not a surprise. But if the probabilities, the Fed looks at the Fed funds rate, and if they see the probability is below 70, they are not going to want to upset the market now. So it creates confusion because it's not a full decisive decision. So this probability is still dangerous. So that is the big issue we're looking at here. And now what I'm seeing, I'm going to talk about, well, I'll have to bring up the next level, is what's going to happen to bond rates. Essentially now, let me bring up TLT, and we could even show the 10-year and that 10-year, and that's the yield curve, which we've discussed. But essentially, here's how it's going to work. If the Fed doesn't raise rates, then that could signal high-end, or that could mean, okay, recession growth, or there's going to be recession, the growth concerns are real, something's up. One, that could lead to a spike in treasuries in the dollar, but ultimately, even if they don't raise, with what people are expecting, what's going to happen then is that they're going to switch it up and start to cover those shorts, and it's going to bring a bid to, it just pretty much what it's going to happen to fixed income. If they do not raise, based on the expectations that happened a week or two ago that was leading into this, fixed income is going to get rocked. It's going to change the price of bonds, dollar, and other currencies if they do not raise. And if that happens, and then also if they don't raise, even if those people don't cover, the perception alone of thinking a weakened economy might lead to certain assets and bids and dumps and other asset classes, but mainly fixed income. Now, if they do raise, this is the issue, because if they do raise, it's expected, but it's not really expected now, because you have, again, we're talking a 68% probability when people were 75% probable last week and even higher before that. So that's volatility, my friends. That's changing. So if they do raise rates, then it's still showing hawkishness, and it's showing also the Fed isn't going to care, and it could bring us back to, it could be bad, but that would be probably the best case scenario. Even then, even if we do not raise, that could indicate we should be at the same rate, the price as the rest of the world, because I'm going to go talk about that in the next video. I'm going to show you guys the economies and the stock markets from across the globe right now. You'll notice a pattern in the United States is holding up for one specific reason, and it could be just this, that our rates, our money market, our financial markets, they're good, and we're not really showing that panic as other people would. So that being said, this is where Japan comes in. So I brought this up a few weeks ago. If you've been watching the videos, some people have thanked me for seeing this correlation. I'm glad it could help you. Like I say, don't get too caught up with these though. You never know, because today was a day where the Jappies started leading, but oil, it's not always going to work like this. But today we see a correlation, and at times we will. Here's the longer term, but now it's like, okay, what the fuck does Japan have to do with the Fed raising rates or this and that? Here's your historical lesson. It's Japan's history with bonds, bond buying, and their central bank policy since the recovery, and their economy itself is linked with us as well as the Pacific. We do a lot of trade with them, but how they operate their central bank is very similar to us and the Fed, and it's different in a way that they've taken more bigger measures where to see what would happen if you don't have enough room to lower rates. If you lowered beyond zero, what would happen? Japan's done that. They're the first modern economy to do so, where we could see that. Japan has a long-term buying yield curve control program. So there's a lot of similarities in terms of Japan is our lesson, as well as they were where we were at one point. Japan was the biggest economy in the world and faded, and now you could say Japan is either leading us or we're nothing like them. Who knows? But the aspect is how it comes down to central banks and operating. Japan is important. And then now on that same note, the simple fact that Japan is one of the most active bond buyers of their own market. Their central bank is very, very active in what they do with bonds and controlling fixed income, and even the effect United States markets can have on Japan fixed income, which is a fucking ticking time bomb, is pretty insane. So this is what's happening. That's why it is kind of a black swan, a gray swan. Oh, really, I'm not trying to make any assessments of that, and I'm sorry if I did say that and it got taken that way. All I'm trying to say, this is going to be a very, very crucial event. And honestly, how it's set up right now, what I just explained is the two ways investors are looking at in the market, myself included. But what could also happen is that we see, this has been a common theme of the market, which I'm going to close this video on. Market has been taking expectations. We have these expectations, everything listed here. But then the news comes out. Once the news comes, it's digested and processed just completely different, and you know, things change. So that's why you got to be careful, you got to be nimble and ready to move. But this is why I'm giving you an idea of understanding what's happening, and you guys could start prepping and preparing just to see, you know, to make some paper trades, learn and watch the market and see how these catalysts come into play. And you guys are getting to watch all this, see how I'm going about it. It's fun, I'm excited, there's a lot of info. And two, this is just the market. This isn't always going to be like this, where politics, news, and events drive the market like this. So as somebody into fundamentals and politics like I am, this is when the markets get exciting. It gets really boring after this. So that's why I'm paying attention, and hopefully you guys are too. But I'll leave it there. Hopefully you guys like it. Subscribe, drop me a comment, give me some feedback. Let me know what you think. We're hitting new lows. Oh, what's going to happen? I got a bunch of cool videos, so get ready. A lot of videos. Peace.